Okay, so we started off with what was, I think, part one, which kind of makes sense, didn't it? So we had in fact, we didn't start with part one. We had an introduction where we talked about the format of the exam. That was all of 5 minutes long, I think. And then we had part one, where part one was, I think, if we're looking at paper F7, a rather long and overdrawn look at when you consolidate and when you don't consolidate. I think part one of this was particularly relevant for paper P2. And where I really saw it was organising IPSAS implementation in practice. So governments, which units had to actually consolidate and which units don't. What we're moving on to now, I think, is much more relevant for paper F7, and this is where we're going to actually talk about how we actually do a consolidation. So what's the approach, what's the steps that you go through, and I'm going to do a very simple, I have to say the example is more simple than you get in the exam. So I'm actually going to do a consolidation for you and show you how to do it on the screen here. Right. Okay, if you're doing a question in paper F7, it's going to be fairly obvious. The examiner is going to give you a company which, spookily enough, their name will start with the letter P. They will have acquired some shares in another company. Their second company, their name will, spookily enough, start with the letter S, and you have to bash together the consolidation. If you're doing this in practice, or if you're doing this at paper P2, it may not be quite so obvious when you actually need to consolidate and when you don't. So here it said that the consolidation procedure is very basic principle. Required in a business combination is by the acquisition of, here we've got the acquisition of shares, never required when it's acquired through assets alone. Note that it's also not required when we acquire acquisition of stock and the stock are acquired. So the shares rather are acquired of a company which is being liquidated. If the company is actually being liquidated, the reason is because you're acquiring the assets as well. Right, this is for paper P7 what's absolutely critical. Because what's going to happen to you is you're going to be given a couple of pages of information which is going to include, as a minimum, a couple of balance sheets. Now at the moment we're just looking at this statement of financial position, please let's call it a balance sheet. And the only way to do this, and not the only way, but more or less the only way I've ever seen to do this, to get everything done in time and accurately and quickly, is to set this thing up as a worksheet. And what you're going to do on your page is you're going to draw 4 columns. So you set your page up, 4 columns. The first column is going to be the balance sheet of the parent company. The second column is going to be the balance sheet of the subsidiary company. The third column will be adjustments, and the fourth will be consolidated. Right, the next thing that you do is you simply copy into columns 1 and 2 the balance sheet of the parent company, and you copy down the balance sheet of the subsidiary company. The reason that you do that is that 30% of the marks in these questions, bearing in mind this is going to be a 30-mark question, so 30%, 9 of the marks out of 100 are going to be simply for numbers that do not change. So copy those down. Column 1 is the balance sheet of the parent company. Column 2 is the balance sheet of the subsidiary company. Now when you do this, leave lots of space, because you've got to go back in and put in goodwill and stuff like that. You should therefore have, with 2-3 minutes gone into the question, because you'll have done this 25 times, you should therefore now have 2 balance sheets copied out onto the page. And the examiner doesn't normally make them that long, so current assets will normally be 1 number and so on. Then what's going to happen is you're going to come away from that and you're going to do a little calculation of what was the value of the net assets of the subsidiary company at the date of acquisition. And at the date of the balance sheet. So you will have those 2 things there. You will have your calculation of the value of the net assets at the date of acquisition and at the balance sheet date, the date which you're preparing the consolidation at. Bearing in mind, therefore, that you will have at that stage, at the date of acquisition, you will have the equity capital, you will have any retained earnings at that date. Other things that you're going to have at that date is that you're going to have fair value adjustments. So you will inevitably find that the value of the assets has increased, or you may even find that some has decreased. Once you've got that, you can then calculate your goodwill, write your goodwill into your worksheet as soon as you possibly can. So we put the goodwill into our worksheet, and we take out, at this stage, any things which we know that can't possibly be there. Investment in subsidiary will go, equity shares of the subsidiary will go, because remember back to the last class what you're doing. You are showing this combined entity. P, the parent company, has external subsidiaries, so this block unit. Right, but here we've got no controlling interest. Look at the heading here, there's no non-controlling interest. So we've got 100% in the shares. Therefore, the parent company has an investment in the subsidiary. Right, you can't invest in yourself, that has to go. Equally, the equity shares in the subsidiary are all owned by the parent company, so they have to go as well. You can't own shares in yourself, it doesn't make sense. So we take out those shares as well. There will be a missing number. What's the value of the investment will be what we paid, and what we got back will be equity shares and retained earnings. The missing number that makes that thing balance will be your goodwill. So you will credit out the investment, you will debit out equity shares, you will debit out the retained earnings at the date of acquisition, and then your missing number will be your goodwill. Right, if that all sounds awfully complicated, you're going, I have no idea what you're talking about, Mark. Don't worry about it, because we're going to do an example, and I'll show you exactly where these numbers come from. Okie doke. Right, IFRS 10 and 11 tell us that when we calculate the value for goodwill, we have to include the fair value for assets. So therefore, if we look here, you'll see that the current value of the inventory is 2,500 more than the book value. So you have to take that into account. In other words, you're going to debit the inventory, and we're going to credit. In fact, what we're going to do is we're ultimately going to credit the investment. Now, I'll show you where these things go later on. But you need to take account of these things. So look at what you've got here. Now, what's going to happen is this we're going to use as an example. So in our example, you can see here that we have inventory, we have land. The land has gone up by 15,000. The equipment has gone up by 25,000. And the value of the patent has actually gone down by 7,500. So what we're going to have to do when we calculate the goodwill is we're going to have to take into account that 35,000. Are you okay where the 35,000 comes from? It's 2,500 for the inventory, 15,000 for the land, 25,000 for the equipment. Those things are all pluses, minus 7,500 for the patent. Okay? Right, take a note of those things because they're going to become important later on when we do the actual example. Right, so what you've got here therefore is the basic information which has been listed from a question. Now, I don't actually like this slide because, in fact, what this slide should do is it should show 4 columns and it only shows 2. So please remember you're going to have a column 3 and a column 4. So you've got your cash, you've got your receivables, your inventory. Notice here that in P you have an investment, and the investment is 150,000. The land 200,325, and if you add all of those things up, you should, I hope, get 983,000 for P and 200,000 for S. Right, what I strongly recommend you do is go to the website and print this thing off because you're going to be using it very much soon. Okay? Right, I hope therefore that there's everything that you understand there. And do remember that these numbers here are numbers which are before any adjustments. Right, I've actually added in this slide. I didn't like the last slide because it doesn't show you all of the columns. So please have a look at this slide now. Lovely there. Slate grey, isn't it? And you'll see therefore that on the right hand side you've now got 2 columns, one of which is adjustment and one of which is consolidation. So we've got our 2 slides. Please tell me that this is the same slide as you saw before, but with these 2 extra columns. That is exactly what your page should look like just now. Here what we have is we have the capital section, the credit side, so the other half of the balance sheet, so what we would call the bottom half. Notice you've got your accounts payable, you've got some bonds there, and then we've got our capital, which presumably is our equity shares, retained surpluses, and then our totals. And if everything is good and fine, then we should also find that this thing balances. Right, so that's just simply the bottom half of the balance sheet. Note now that you have your adjustments there as well. Right, now on slide number 8, it's beginning to get a little bit more difficult. So what we're doing at slide number 8 is we are calculating the goodwill. Okay? Right, first thing to say is how much did we pay? Well, we know how much, remember, P is the parent company, S is the subsidiary. So we know how much P paid, because if you look in their balance sheet as an investment, it shows investment, and it shows that they paid 150,000. So P paid 150,000. Right, what did we get for our money? Well, everything that we're dealing with at this stage, we're dealing with at book value. So the first thing is they got some shares. Now, if you remember back to the start of the lecture, it told us that there were no non-controlling interests. So in the good old days, what we used to call minority interests. So in this question, these guys do not exist. Therefore, we have purchased 100% of the company. So we purchased all of the shares. Look at the balance sheet of the subsidiary, and you will see in the capital section that the value of the shares is 50,000. So we purchased at book value. So we purchased book value of shares of 50,000. So we paid 150. What did we get in return? We got shares with a book value of 50,000. But we didn't only get shares, also the company had some retained surplus at the date of acquisition. So we take retained surplus at the date of acquisition, because what came before we owned the company doesn't belong to us. So look in the balance sheet. Remember, we purchased 100% of the organisation, so we got 100% of the retained surplus, 45,000. So we got 50,000 of shares, 45,000 of retained surplus, which gives us 95,000. Right, in addition to that, we also got our fair value adjustments. Do you remember that we obtained 35,000 positive of fair value adjustments? Like, those fair value adjustments are the increase in inventory, the increase in land, the increase in equipment. Now, if you look on the slide, they're given to you on the right hand side. So inventory's gone up 2,500, equipment's gone up 25,000, land 15, and the patent has actually gone down from book value of 7,500. So we paid 150,000. In return, we got shares of 50,000, plus we got retained surplus of 45,000, plus we got fair value adjustments of 35,000. So add those things up, and they add up, I hope, to 130,000. There's a missing number. We paid 150, we got 130. So what does the missing number relate to? The missing number, therefore, is your goodwill. So therefore, your goodwill is 20,000. Right. Now look at it in terms of debits and credits. P has in their balance sheet. Now remember, you've got a worksheet, so P has in their balance sheet an investment of 150,000. That investment needs to come out. So we have to credit that investment. Okay, so we credit the investment of 150,000. If we're crediting it, there must be debits which are equal to 150,000 as well. We will debit the share capital of S. We will debit the retained surplus of F. We will debit consolidated inventory. We will debit consolidated land. We will debit consolidated equipment. We will have to credit the patent, and that will leave us with a missing number. And the missing number is a debit goodwill of 20,000. If you add up all of those debits and credits, they will balance. What you should not do in the exam is actually do a T account or something. Remember, you have your adjustments column. You're going to put all of those numbers now into your adjustments column. So you will reduce the investment, you will reduce the share capital, you will reduce the retained surplus, and by doing that, you just put them into the adjustments column. But by doing that, it cuts your time so very much. Right, I really hope that you understand where all of those numbers come from. Go back and look at the slides for the assets and the liabilities, those two slides, which I think are 6 and 7 and 8, something like that. And you'll see where the numbers go. Okay? Right, if you don't understand it just now, get some basic ideas of the principle and do more and more question practice. I'm going to be posting more and more videos on this over the next few days because I'm teaching this. You've got to get this for the exam, okay? Because if you start doing T accounts or you have the wrong approach, you're just not going to have time. The time pressure will kill you in the real exam. So what we're doing on the slide now is that we're simply putting through all of the adjustments that we made. So I hope you'll see there, if you take the last slide, we're just putting through the debits and the credits. So the inventory, the land and the building and equipment has all increased in value. And so that's what we're doing. Look now at the combined value, the consolidated value of inventory. It's 175,000 from P, 40,000 from S, plus the fair value adjustment. So you've debited it. Land is the same, building is the same. Now have a look at the patent. We said that the patent had 0 value, so we've credited that. The investment in S as well, you can't have an investment in yourself, so we've credited it. And you saw the debits and the credits on slide number 8. And you'll see that your missing number there, the goodwill, has gone in as well. So your debits and your credits all equal 150,000, it'd be more, right? 157,500. But your debits and your credits all balance. Okay, I hope that's straightforward and you can see where all of those numbers come from. What you need to do is print this stuff off. So go to the website, and it should be down there somewhere. Go to the website, run off from the website the slides, and then just tick these off against the things that were on slide number 8. Please note that in the exam, this is by far the quickest way to do this, because as soon as you can put those numbers in, and remember, you've only got to get half of them right to pass. So stick those numbers in. Don't do T accounts, don't do any fancy entries, you're just putting through an adjustment column. Right, slide number 10, which I hope is the next slide, will be the same, but with the liability side of the balance sheet. So the principle is the same again. It can't possibly be that S has any share capital. Think about the logic. We're looking at this as one entity. So therefore, the share capital of S must disappear. Otherwise, it means that P holds shares in itself, which is a nonsense. So we've taken out, we've credited S. Again, it's shown to you on slide number 8. 45,000 as well as the retained surplus. Right, notice that this is the retained surplus at the date of acquisition. Now, in this question, we're preparing the consolidated balance sheet at the date of acquisition. In the exam, you almost certainly won't. So we only credit out here, the retained surplus that has arisen since the date of acquisition, before the date of acquisition. We take out, we debit out, we remove any retained surplus that S had before the date of acquisition. Anything which remains afterwards is a group asset, is a group credit, it belongs to the group. Right, this lecture is just absolutely nothing whatsoever to do with accounting and everything to do with exam technique and approaching the exam. You are going to be crippled in this exam by lack of time. The examiner is going to give you 45 minutes to do a consolidated statement of financial position, and there's going to be a whole stack of adjustments in there. You've got to learn to manage this question. You've got to learn to get the question down on paper with the answer in time. And please remember, if the damn thing doesn't balance at the end of it, nobody cares. You've got to get 51% of the marks. Right, that was a really, really simple little question that I gave you there. Therefore, excuse me, what do we do? Draw your 4 columns, P and S, put through your adjustments, and your adjustments are all given to you in the questionnaire. You know that the investment's got to disappear, you know that S's share capital's got to disappear, you know that the amount of the retained profits at the date of acquisition has to disappear, you know that there's going to be fair value adjustments. Take them out, add across, bingo, you're home. Okay, thank you. We're going to go on now and do the next one. Will be a simple little example again. But the next time is that they're only going to acquire, I think it's 80% of the shares, I can't remember. So they're going to acquire something less than 100% of the shares. So get that one down as well, and then you just got to do exam question after exam question and back these things out time and time again.